Back in 1997, Warren Buffett did something that shocked the investment world. The Oracle of Omaha, a man who openly despised precious metals and famously called gold a pet rock, quietly accumulated 129.7 million ounces of silver. That's over 3,500 tons, nearly one-third of all above-ground silver at the time. Today, as silver hovers around $62 per ounce on December 14th, 2025, that same contrarian logic is playing out again. And the question everyone's asking is, are we about to witness history repeat itself? The original silver play. Let me take you back. It's July 25th, 1997. The silver market is dead. Prices have collapsed from $50 an ounce in 1980 to below $10. The Hunt brothers' failed attempt to corner the market had left silver radioactive in the eyes of serious investors. Nobody wanted to touch it. But Buffett saw something different. He saw arithmetic. Simple, beautiful arithmetic. Between July 1997 and January 12, 1998, Berkshire Hathaway methodically purchased its massive position. They paid between $4 and $4.5 per ounce. The total investment? Approximately $680 million. What did Buffett see? Three things, three indicators that made silver irresistible. First, production was running 100 million ounces below consumption annually. Every single year, the world was eating through its silver stockpile. By 2001, the cumulative deficit stood at 1.2 billion ounces. Second, above-ground inventories were plummeting. There might have been a billion ounces of bullion sitting in vaults in the mid-90s, but that cushion was disappearing fast. Third, and this is crucial, silver production is inelastic. Unlike other commodities, you can't just flip a switch and mine more silver. Why? Because less than 1/5 of silver production comes from primary silver mines. Most silver is a byproduct of copper, zinc, gold, and lead mining. As Buffett himself said, there are relatively few pure silver mines, so it is not easy to add production. The market didn't care. The market was asleep. But Buffett knew that when supply and demand get this far out of balance, prices have to move. It's not a question of if, but when. The exit that came too soon. By 2006, Buffett sold his entire position. He made over $500 million in profit. Not bad. But here's the kicker. If he'd held just 3 more years, he would have seen silver hit $48 in 2011. His position would have been worth over $6 billion. Did he sell too early? Maybe. But Buffett's investment thesis had played out. The supply-demand imbalance corrected. Prices rose. Mission accomplished. Fast forward to today. Now here's where it gets interesting. Because as of December 14th, 2025, all 3 of Buffett's original indicators are flashing red again, and the situation might actually be worse than the 90s. Let's talk supply deficits. The silver market has been in deficit since 2021. In 2023 alone, the shortfall was 184.3 million ounces. For 2024, consumption is projected at 1.21 billion ounces. Supply? Only 1.03 billion. That's a deficit of 182 million ounces. Think about that. We're consuming roughly 20% more silver than we're producing. And this isn't a one-year blip. This is year 5 of consecutive deficits. Inventories are cratering. The London Bullion Market Association has hit critically low levels, according to commodities strategist Daniel Ghali. Their 135 million ounce stockpile could be depleted in just months. COMEX inventories are down 70% from their 2020 peak. India's largest precious metals company is sold out of silver for the first time in history. And supply? Still inelastic. Total silver supply has actually declined over the past decade from 1.07 billion ounces in 2010 to 1.03 billion in 2024. Meanwhile, demand keeps climbing. But here's the twist. There's a fourth factor that didn't exist in Buffett's era. A factor so powerful it might be the single biggest driver of silver prices in the next 5 years. The industrial demand tsunami: solar panels, electric vehicles, artificial intelligence, data centers, semiconductors. Industrial demand now accounts for more than half of total silver consumption, and it's accelerating. Let's start with solar. In 2022, solar used 12% of global silver supply. By 2024, 25%. That's a doubling in 2 years. Sprott estimates that by 2030, solar will need 370 million ounces annually. That's roughly 40% of current total supply. Electric vehicles are another massive sink. Every EV requires significant silver for electrical contacts, circuit boards, and battery components. As EV adoption accelerates, so does silver demand. Then there's AI, the infrastructure powering artificial intelligence, the servers, the chips, the cooling systems, requires enormous amounts of silver. Data centers are consuming silver at unprecedented rates. And unlike jewelry or investment demand, which can decline when prices rise, industrial demand is sticky. You can't build a solar panel without silver, You can't manufacture semiconductors without silver. You can't skimp on the silver content in an EV's electrical system and hope it works. This is structural demand, and it's growing. Silver started 2025 at $29.29 per ounce. By December 12th, it had rocketed past $64, smashing through its previous all-time high and notching gains of over 119% for the year. Let me put that in perspective. Silver has outperformed gold, which itself has had a monster year. The gold to silver ratio has compressed from over 85 to around 67. Historically, when this ratio drops below 70, silver tends to keep running. On December 9th, silver hit $60 for the first time ever. On December 10th, 61.85. On December 12th, 64.64. The rally has been relentless, and then, as these things go, profit-taking set in. By December 13th, silver had pulled back to around $62. Is this the top, a healthy correction, or just a pause before the next leg higher? What the experts are saying. Bank of America raised its 2026 silver forecast to $65 per ounce, with an average target of 56.25. But they also warned about near-term correction risk. TD Securities' Daniel Ghaly sees silver sleepwalking into a potential stockout, similar to what happened in copper and platinum markets. His prediction? $40 by year-end. But wait, we've already blown past that. His analysis was from earlier in the year, and silver has exceeded even bullish expectations. Some forecasts are eye-watering. CoinCodex projects silver could hit $240 by end of 2026. Long forecast estimates $70 to $100 by year-end 2026. Even conservative estimates are calling for prices in the mid-70s to low 80s, but there are skeptics. HSBC raised its forecast but still projected averages around $35 for 2025, a number that already looks quaint given December prices. They're modeling a 206 million ounce deficit but remain cautious about permanently higher prices. The World Bank acknowledged precious metals surge but projects a slower pace of gains in 2026 compared to 2025. The bear case. Let's be clear, not everyone is convinced this rally has legs. First, silver is cyclical. It always has been. Every major silver bull market has ended in a spectacular crash. 1980, 2011. What makes this time different? Second, valuation concerns are real. Some analysts, like those at Axis Mutual Fund, warn that silver's rapid ascent could trigger significant volatility in 2026. When assets move this far, this fast, corrections can be brutal. Third, there's the blow-off top risk. TD's Daniel Ghaly specifically warned that the move resembles a risky blow-off top. Fed chair. Jerome Powell indicated no further hikes, but projected only one additional cut in 2026 and another in 2027. If real yields rise or the dollar strengthens significantly, precious metals typically suffer. Fifth, supply could respond. Yes, silver supply is inelastic in the short term. But persistently, high prices will eventually incentivize more exploration, more mining, and better recycling. The deficit can't last forever. The bull case. But here's why 2026 could vindicate the bulls. The deficit math is undeniable. 5 consecutive years of consuming more than we produce. Inventories at multi-decade lows. And unlike 2010 or 2011, there's no massive above-ground stockpile to buffer the market. Industrial demand isn't speculation, it's necessity. Countries have committed to net zero carbon targets. That means solar, lots of solar. The transition to electric vehicles is a policy imperative across Europe, China, and increasingly the US. The AI revolution isn't slowing down. These aren't trends that reverse overnight. The critical minerals designation matters. The U.S. Geological Survey's final 2025 critical minerals list added silver among 10 new additions. This links silver to national security and strategic stockpiling considerations. Russia has already announced plans to acquire $535 million worth of silver over the next 3 years, the first time any central bank has explicitly included silver in purchasing plans during this bull market. Central bank behavior is shifting. As faith in fiat currencies erodes and inflation remains persistent, even traditionally gold-focused central banks are looking at silver. It's not just Russia. If other central banks follow, even modest allocations could absorb significant supply. The gold analogy is instructive. Buffett hates gold, always has. Yet in 2020, Berkshire bought over $560 million of Barrick Gold stock. Why? Because he recognized that in a world of unprecedented money printing and fiscal stimulus, hard assets would rise. That position has since been sold, but the point stands. When macro conditions align, even Buffett bends his rules. Silver is gold's scrappier little brother. It has all the safe haven properties of gold, but with the added kicker of industrial demand. It's both a monetary metal and a technology metal. That dual nature gives it unique leverage. The 2026 inflection point. So why is 2026 the year that matters? Because that's when the various forces either come together or fall apart. On the supply side, 2026 will be the sixth consecutive year of deficits if current trends hold. At some point, you can't keep drawing down inventories. Something has to give. Either price rises dramatically to ration demand, or new supply comes online. Given the inelastic nature of silver production, new supply won't arrive quickly. On the demand side, 2026 is when major solar installations ramp up globally. It's when EV penetration crosses critical thresholds in key markets. It's when AI infrastructure build-out accelerates. The demand curve is steepening. On the macro side, 2026 is a year of potential policy shifts. Will the Fed cut rates further or hold? Will inflation resurge? Will geopolitical tensions escalate? Will the dollar weaken? These factors will determine whether precious metals continue their run or stall out. And then there's sentiment. Right now, silver is hot. Everyone's talking about it. Retail investors are piling in. ETF inflows are surging. When sentiment gets this frothy, two things can happen. Either you're at the beginning of a true mania phase, or you're near a top. 2026 will tell us which. What would Buffett do? Here's the fascinating question. Would Buffett buy silver again today? On one hand, the fundamentals look even better than 1997. The deficit is larger. The industrial demand story is stronger. The strategic importance is clearer. On the other hand, Buffett has always been allergic to chasing hot assets. He famously said he only buys when others are fearful and sells when others are greedy. Right now, silver is anything but unloved. It's up 119% in a year. It's making headlines. That's usually when Buffett walks away. But remember, Buffett didn't buy silver in 1997 because it was cheap. He bought it because the supply-demand math was broken and prices had to adjust. The cheapness was just a bonus. Today, supply-demand math might be even more broken. But the price is already reflecting a lot of that story. Silver at $62 has already priced in a significant amount of bullishness. The Buffett playbook says, buy when you have a margin of safety. Is there a margin of safety at $62? That's the trillion-dollar question. The scenarios. Let's game out 2026. Scenario 1, the bulls are right. Silver breaks $70 in Q1 of 2026 and doesn't look back. Supply constraints intensify. A major geopolitical shock or inflation spike sends investors flooding into precious metals. Industrial demand continues its relentless climb. By end of 2026, silver is trading in the $85 to $100 range. Early investors double their money. Buffett's original thesis is vindicated on steroids. Scenario 2, the pause. Silver consolidates in the $60 to $75 range for most of 2026. The market digests the massive gains of 2025. Supply and demand gradually come into better balance as higher prices incentivize recycling and marginally boost mine output. Industrial demand grows, but not explosively. By year end, silver is modestly higher, maybe $70 to $78. It's a win, but not a home run. Scenario 3, the correction. Profit-taking turns into a rout. Silver drops back to $45 to $55 as leveraged speculators are forced out. The blow-off top thesis proves correct. However, strong physical demand from industrial users provides a floor. The bull market isn't over, but it needs to reset. 2026 becomes a year of volatility and opportunity for patient buyers. Scenario 4, the crash. Something breaks. Maybe it's a global recession. Maybe it's a surprisingly hawkish Fed. Maybe it's a China slowdown that crushes industrial demand. Silver plunges back to $35 to $45. The rally of 2025 is exposed as speculative froth. The structural deficit story is real, but it takes another 5 years to play out. Buffett's timing in the 90s, getting out before the peak, looks brilliant in hindsight. The verdict. So, will 2026 prove Buffett right or very wrong? Here's my take. Buffett's core thesis that silver is unique among precious metals because of its industrial demand and supply inelasticity is more valid today than ever. The fundamentals supporting higher silver prices are real, significant, and structural. But timing matters. And Buffett himself would likely tell you that buying silver at $62 after a 119% rally is not the same as buying it at $4 after a decade-long bear market. The question isn't whether silver will be higher in 5 or 10 years. Given the deficit math and industrial demand trends, it's hard to construct a scenario where silver doesn't trade significantly higher by the early 2030s. The question is whether you can stomach the volatility between here and there, because silver doesn't go up in a straight line. It's going to have 10, 15, 20% drawdowns. It's going to have weeks where everyone thinks the party's over. It's going to test your conviction. Buffett made his fortune not by being right about everything, but by being right about the big things. and having the fortitude to hold through the noise. He bought silver when nobody wanted it. He sold when the thesis played out. He didn't try to catch the absolute top. If you're buying silver today, you need to ask yourself, am I buying because the fundamentals are compelling, or because I'm afraid of missing out? If it's the former, you might be fine. If it's the latter, you're probably going to have a bad time. 2026 will be the year we find out. The year the deficit either becomes a crisis that sends prices to the moon or resolves in a way that disappoints the bulls. The year industrial demand either accelerates beyond all projections or moderates as innovation finds substitutes. The year the macro backdrop either supports precious metals or turns hostile. Warren Buffett taught us that the market is a device for transferring money from the impatient to the patient. Silver in 2026 will test that lesson, because the patient investors who bought the dip in 2023 and 2024 are already sitting on massive gains. The question is, will the impatient investors who are buying now end up transferring their money to someone smarter? History doesn't repeat, but it often rhymes. Buffett saw an imbalance in 1997 and acted. The imbalance we see today might be even larger, but so is the price. And that's the tension. My advice, don't try to predict the top. Don't bet the farm. But if you believe in the structural story, and I think you should, then silver deserves a place in your portfolio. Just size it appropriately. Just be prepared for volatility. And just remember, Buffett didn't get rich from silver. He got rich from businesses that generate cash flow and compound over decades. Silver is a bet. A calculated bet, maybe. A well-researched bet, certainly, but still a bet. 2026 will show us if it's a winning one.